Good evening, everyone. Thank you for joining us tonight for the webinar that is presented by Jason DeLorenzo. I'm going to let him introduce himself here in a little bit, but I will give everyone a chance to get logged on and settled. So in the meantime, I will just go ahead and introduce myself. My name is Peyton Jennings, and I'm the Physician Engagement Coordinator here at Practice Match. Some of you attending might already know me because I work really closely with our physician ambassadors. And I do a lot of the career fairs as well. With Practice Match, I really enjoy getting to help the physicians and residents find their job, but also providing extra resources to them, like this webinar included, as well as our free CD reviews, our physician immigration handbook, our career guidebook, and all the incentives we offer as well for physicians just attending our fairs. So if anyone has any questions, I will, guys, let you put those in the chat and Q&A, and we will answer those towards the end. This will be muted throughout the presentation when Jason's speaking, but it is also going to be recorded as well. So we can go back and look on the website afterwards. So Jason, if you're ready, I'll let you take it away.
I am ready. Thank you, Peyton. And thank you all for joining us this evening. Just by quick way of introduction as well. I'm Jason DeLorenzo, the founder of an organization called Doctors Without Borders, and more recently, Benelevate. Between our two organizations, we work both individually with borrowers and with organizations who manage staff who have student loan debt to make sure that you guys are following the right action plan to strategically eliminate your student loan debt using federal resources or resources from your employer as you move on through your career. And that's what we're going to talk about here today. In specific, we're going to talk about some of the recent student loan programs, announcements, and forgiveness opportunities that you've seen in the marketplace recently. The CARES Act, payment halt, student loan cancellation, the public service loan forgiveness program. We'll talk about all of that. And Peyton, if you wouldn't mind, as questions come up here, either in the chat function or the Q&A function, go ahead and read them aloud as they come through. If I don't see them, I'm happy to answer any questions along the way, if it makes sense, and also we can save some time at the end to answer your questions. So in a brief summary of what we're going to talk about here in our agenda, I first like to talk about what are the proper terms to understand when I'm talking about student loan repayment, because some of these terms that you hear us use in the student loan world don't always match the Webster's dictionary definition of these terms. And so we'll go through some terms that it's important, I think, to understand. Then we're going to talk about loan types and repayment options. Presumably, as you've gone through your career, graduated from medical school, or working through your training now, or potentially in practice now, you've seen loan repayment plan options change over time, and forgiveness plans become more generous in recent years. And so I'm going to put a microscope on those programs that make the most sense for early career doctors here. We'll talk about this recent legislation, PSLF, and the recent limited waiver that expands eligibility for this. We'll walk through some case studies, talk about your specific action items based on your profile, and then talk about all the resources that are available to you as you navigate this complex and evolving marketplace. I think now's the time where I'll go ahead and cut off my camera here so we can focus here on the content. And again, please feel free to ask questions along the way. First thing I want to highlight in terms of terms to understand is that your loan lender and your loan servicer, a lot of people don't know this, are often different organizations. So your lender is who ultimately delivered the money to you, who is your originator of your loan. Oftentimes over the years, the originator of loans has been shifted. In many cases, it's moved over to the Department of Education, which is called direct loans. If you have direct loans, your lender is the U.S. Department of Education. And then loans have been serviced over the years, federal student loans, by a number of different private loan servicers, Sallie Mae and Nelnet and Navient. And Great Lakes and Fed Loans, and now Mohila. These are all loan servicer names. Some of them also do lending. But for your federal student loans, your lender is going to be the Department of Education today, and it's serviced by one of 4 or 5 typically loan servicers, all of which I've just named. Because it's important to understand that you'll work with your loan servicer or the U.S. Department of Education's resources and website to manage your student loans throughout your repayment process, not your original lender in some cases. And then it's also important to highlight direct loans versus FFEL loans. This one's really simple. In July of 2010, the federal government nationalized federal student loans, meaning that all federal student loans, your lender became the Department of Education and became called direct loans. Prior to that, prior to July of 2010, the majority of federal student loans were lent from private lenders who participated in the federal lending program. That was called the Family Federal Education Lending Program, FFEL. FFEL loans are considered federal student loans, but they're not direct. So they're not available, they're not eligible for programs like public service loan forgiveness, or even in many cases, broad loan cancellation, which is under consideration by the Supreme Court right now. You can always consolidate an FFEL loan into a direct loan if you find you have these loans. As long as you don't do the next thing here, which is listed refinancing, I want to explain that definition as well, because you've got a lot of companies out there that are private lenders offering to, well, in recent months or over the past year, it's been more difficult to achieve this because interest rates have been moving up. If you've seen that in other aspects of your financial life. Refinancing is when you take a federal student loan and you have a private lender pay your balance off, and then you have a new set of terms, a new promissory note, a new monthly payment, ideally an interest rate that's lower than your federal student loans. That's called refinancing when it comes to the student loan nomenclature today. Refinancing is often not a good idea, particularly for early career doctors who have higher levels of student loan debt, because when you refinance, the private lender's not going to honor all the federal benefits that are really generous right now, such as the payment halt, which we'll talk about. Now, consolidation is a little bit different, at least when it comes to, I've often heard people who just refinance their loans with like SoFi or Credible say they consolidated their loans, and maybe that meets again the Webster's dictionary definition of consolidation. But what we mean when we say consolidate federal student loans, you've got, say, a portfolio of 8 different federal student loans that you took out over 4 years of medical school, and they were lent, twice a year, all at slightly different interest rates. And it's ultimately representing 8 different loans. You may have more from undergrad or another graduate program. You can take all of those federal student loans, all 8 or 12 or however many you have, and consolidate them into one single, still federal student loan. And we often suggest that makes sense for the purposes of administrative ease. It's a lot easier to navigate and manage administratively one single loan versus a group of them. And also sometimes it creates an opportunity to save money. But consolidation keeps your loans federal and simplifies the administrative process. And also, when you graduated from medical school, some of you may have done this, you consolidated your loans to move up or exhaust your grace period or give it up so that you could go right into an income-driven repayment plan that had a 0 payment. I assume that most of you are familiar with income-driven repayment plan as a concept. I'm going to walk through a decision tree on when to use which of these programs, as there are 5, soon to be 6 available income-driven repayment plans. And based on your profile, you may want to choose one or the other, or you might be changing these programs year after year as you evolve through your own profile and your career based on your debt to income profile and who's employing you. So the income-driven repayment plans, the main takeaway here is they base your payments on how much money you make, not how much money you borrowed. That's the biggest takeaway there. So the payments become affordable based on your income, and the payments are going to be the same for borrowers with the same incomes, even if they have dramatically different debt levels. The higher debt you have, the more payment relief you're getting from an income-driven repayment plan, and likely programs like public service loan forgiveness. Now let's hit the recent developments here first. You probably saw last year, the Biden administration announced broad loan cancellation for all student loan borrowers who were making less than $125,000 in adjusted gross income, or if they were in a household, married households were $250,000 or less. The loan cancellation was going to be $10,000 for all borrowers. And then if they had up to $20,000 of student loan debt and they took out a Pell Grant at any point during their education. Pell Grants were grants, they weren't loans, but they were based on economic need of your family. It was reported that Pell Grant borrowers tended to have significantly higher debt than those that didn't need Pell Grants. And so there's a little more relief extended to those who had Pell Grants through this loan cancellation, the broad loan cancellation program. But this all got blocked several months ago by a court in Texas, and then the Supreme Court, a federal court, which then brought it to the Supreme Court, who is in the process of reviewing this now. And we do expect an answer on broad loan cancellation in June. Those of you who have $200,000 or above in federal student loan debt, sure, it would be nice to see $10,000 or $20,000 of loan forgiveness. It's probably not going to move the needle on your overall repayment strategy. And I don't have an opinion as to whether or not this will happen. I think I'm probably 50-50 on it at this point, as whether I expect, based on all the literature I've read, updates that I've seen, positions that I've sorted through, that I'm not sure which way this would go. In either direction would not surprise me. But we do expect that decision in June, and then the decision on broad loan cancellation will likely then drive student loan repayment to begin again. As you know, the CARES Act started in March of 2020, and that halted interest and student loan payments for all federal student loan borrowers. That's been in place now for over 3 years. Our expectation is that after the Supreme Court ruling, and no later than September 1st of this year, that unless there is some extension of relief announced, which also maybe wouldn't surprise us in this environment, but right now all signs are pointing towards borrowers having to go into repayment no later than September 1st of this year. And that's the expiration of CARES. The Public Service Loan Forgiveness Limited Waiver was announced in October of 2021. I'm going to get into the details of that a little later in this discussion. But it is a very generous interpretation of PSLF for borrowers who have been pursuing it for a number of years. And then there's a new income-driven repayment plan that is announced. The most recent announcement suggested that it would simply be a modification to the existing revised pay-as-you-earn program. But the exciting news about that is that payments can be as low as only 5% of your discretionary income, and they're going to use a higher multiple of the poverty level for your discretionary income. If that all sounded super confusing, the interpretation there is that all borrowers using an income-driven repayment plan in this new plan would have lower payments based on their income versus any other plan. And then some of you, if you're already pursuing PSLF, would know now that Mohila is your loan servicer, and over the past year, all of the servicing business for PSLF has moved from Fed Loans to Mohila. In my experience in working with borrowers, Mohila is doing a better job than we saw PSLF do in terms of even resources on their website and how they report progress and customer service, but they are overwhelmed with an influx of applications right now. And so while the service has been of higher quality, or at least the processing of forms and whatnot, the timeline between when you submit forms and when you get responses has been extended dramatically here in recent months. I want to just take a step back here now to talk about loan types. Federal student loans are going to be your Stafford loans, Grad Plus loans. Perkins loans, that program ended in 2017. You may have some Perkins loans from from many years ago. If you were in school back then, we talked about the difference between direct and FFEL loans. And Parent Plus loans are important to understand. If you do have Parent Plus loans, or as a parent, or your parents have Parent Plus loans for you, you always want to keep those separate from any PSLF strategy or any consolidation. Parent Plus loans uniquely, at this point, almost always should have their own separate repayment strategy. And ultimately, those are always the responsibility of the parent to pay back. We have seen and even provided guidance on helping, doctors who have transitioned to practice, who their parents took out Parent Plus loans, they're paying them back for their parents. But from the letter of the law, those loans are always the responsibility of the parent borrower until they're paid off, and they're best not integrated into strategies for public service loan forgiveness or loan consolidations. And then, of course, you may have private loans, institutional loans, banks, credit unions. They're typically not going to be, or not typically, they're always not consolidatable into a federal student loan. Therefore, they can't be considered for PSLF and some of the other federal income-driven repayment plans and others that we'll talk about here. Now, we know that when it comes to repayment plans, the income-driven repayment plans have become the most popular, particularly for doctors in residency. If we know that the average student debt for a doctor today is about $220,000, and it can be significantly higher based on where you went to school and for how long, did you have undergrad debt, all of that. A $250,000 loan balance is going to cost over a 10-year standard repayment plan probably close to $2,900 per month at today's interest rate. So for obvious reasons, residents and fellows don't choose standard repayment. They choose payment relief, and that best comes in the form of these income-driven repayment plans that are available to you. The CARES Act payment halt, which also has halted all interest accruing, that's technically considered an administrative forbearance. So outside of that, when your loans are free, I refer to forbearance on your student loans as the F word. It is a pejorative because that is going to add the greatest amount of long-term cost to your federal student loans. It doesn't apply for it's not eligible for any student loan forgiveness from either public service loan forgiveness or the income-driven repayment plans, and all of your interest accrues against you and will capitalize year over year. So while you get payment relief in the short term, it extends and increases the student loan payment responsibility that you have over the life of your loans, and is almost always not recommended outside of the CARES Act. There are 5 of these income-driven repayment plans, and to simplify this for you, the most common question that we get here is, are you going to base my monthly student loan payments on my individual income, or if I'm married to a spouse that works, my household income? Because if you only want your payments based on your individual income and not your spouse's income, you're going to have to file your taxes each year, married filing separately, to isolate your own income and make payments based on it. And that's going to dictate which of the income-driven repayment plans you can use. And normally you want to use your tax filing as income documentation for using these plans. So there are 5 plans available today. I've highlighted in red those 2 that I've never recommended to any borrower: income contingent repayment, which is now about 30 years old. And then there's income-based repayment, pay as you earn, a new IBR, which was announced in 2014, and then revised pay as you earn, which was announced in 2015. Depending on if you are going to be, if you're single or if you're married filing separately or married filing jointly, that's going to dictate which of these plans you use, as well as when you took out your federal student loans. So the first distinction to make here is between income-based repayment and pay as you earn. As long as you took out all of your federal student loans before October 1st of 2007, so we're looking at 16 years now, you're never going to want to use income-based repayment. You're going to be choosing between pay as you earn or revised pay as you earn. And here's how you make that decision. If you're single and you've got limited progress towards PSLF so far, which is a 10-year requirement, we'll get into the details of that shortly. You're almost always going to use the revised pay-as-you-earn program. It offers the lowest payment, and anytime your payments aren't covering all of your outstanding interest, you get an interest reduction. It's half the outstanding interest is not charged to you. Now, if you're married and your spouse is earning nominal income, we're saying here less than $20,000 a year, our suggestion, it almost always makes sense, file your taxes married and jointly. The household of two, or even if you have dependents as well. And the fact that you don't have to subject yourself to potential higher tax liability by filing separately normally works out in your favor, so that you don't have to worry about filing separate if your spouse is making less than $20,000 per year, which would mean if you can consider yourself single there, you would still always use revised pay as you earn. So it's when your spouse is earning $20,000 or income of more is when we like to suggest slice it both ways. See, look at what your payments are going to be like based on your spouse's income being included, that is you filing jointly. And if the payments are more desirable, such as, and then loan forgiveness is greater as a result of filing separately, then go ahead and file your taxes married and separately. And in that case, you're not allowed to use revised pay as you earn as it is today, because that application process always requires that you file, that you submit your entire household income to dictate your payments. So whether you file separately or not, they're still going to make you use your household income with revised pay as you earn. So you'd have to use either pay as you earn or IBR in these cases. So this is the decision tree, and we hope it's helpful in as you are navigating these income-driven repayment plans as they evolve. Also, good news is that I mentioned that change to revised pay as you earn would allow you to file your taxes married and separately and still use revised pay as you earn. It would also make some of your student loan payments as low as 5% of your discretionary income. That would be based on what percentage of your debt is undergrad debt. So that I would say that virtually, if that plan goes through, you would never want to use any other income-driven repayment plan besides the new revised pay as you earn. So you definitely want to stay apprised of if that proposed change does go through, because most borrowers are going to be, I would say all borrowers would want to be using the new modified revised pay as you earn, even if they were married intending to file separately. So what is public service loan forgiveness? I've been mentioning this program. My assumption is that the schools are teaching this now. We've done that at Doctors Without Quarters over the years and continue to do so now. Just a refresher, this requires 10 cumulative, not consecutive years of full-time qualifying work while you're in the right kind of repayment and you're in the right kind of loan. Now, we always get this question, does the CARES Act payment halt count towards public service loan forgiveness? And yes, it does. Your 3 years of non-payment here, assuming you graduated and weren't taking on additional student loan debt, your 3 years of non-payment in the CARES Act does qualify as time spent towards public service loan forgiveness. So these 3 years in the CARES Act, if you've been working for a 501c3, nonprofit, or any federal, state, or local government or agency, you've got 3 years done towards these 10 years required. So the requirement is to make 7 years of payments ongoing before you're eligible for complete tax-free loan forgiveness. Qualifying loans, again, must be direct federal student loans. If you have FFEL loans, Perkins loans, or for some doctors that might have LDS, loans for disadvantaged students, or HPSL, those are health professions student loans, they can be consolidated as well and eligible for PSLF. And coming out of the CARES Act, a qualifying repayment plan is only going to be an income-driven repayment plan or a plan based on the standard 10-year repayment plan. So that really means that you should be using an income-driven repayment plan. So while this retroactive look from the waiver is much more generous for borrowers that have been doing this for some time and we're told no, coming out of the CARES Act, when you go back into repayment, you're going to need to be in the right kind of loan, and you're going to need to be in a qualifying repayment plan, which is an income-driven repayment plan. And then full-time employment for a qualifying employer. There is some legislation proposed to expand this definition, but for now, it is direct employment by any 501c3 nonprofit or any federal, state, or local government or agency. So you can't be a 1099 contractor, or you can't work for a private entity that's then contracted with a nonprofit entity. If your paycheck is coming from a non-qualified entity in today's PSLF program, you're not eligible for public service loan forgiveness. They are proposing broadening this for doctors who are paid by for-profit entities but are working in public service entities. It's California and Texas are the states that have the most strict interpretation of federal Stark law, where there's a lot of private physician groups that are still working in the public service capacity. And we do expect that in the future, whether that will be retroactive or not is tough to tell. We would certainly hope so, and there's advocating for that, but moving forward, that time may qualify. And I've seen that proposed legislation. So as of today, must be directly employed. That's where your paycheck comes from. You've probably seen, particularly if Doctors Without Borders was doing your exit counseling at med school, what the repayment program looks like over 10 cumulative years. Your payments are virtually nothing during residency and fellowship, because with $50,000 to $60,000 of annual income, the income-driven repayment plans are typically anywhere between $0 and say $300 or $400 per month at the most. Then when you transition to practice and you're earning, say, a $200,000 salary is what we're showing here, your income-driven repayment plan payments will start to jump up. Here in year 7 is when the payments jump up to about $1,500 per month. Because we're using last year's tax return to set payments for the next 12 months, there's still a little bit of a lag here before your payments actually go up to be based on your existing salary. And so over the course of 10 years here, we're talking about, these are years 5 through 10 in this example. Years 1 through 4 were presumably spent in residency, where little was paid on the student loans. The 10-year payment trajectory is under still $100,000. So if this borrower came out of medical school with $300,000 in student loan debt, that would normally cost to pay back over 10 years around $400,000. Here with PSLF, over this 10 years, if you do it right, you're only paying $96,000 out of pocket. And those are income-driven payments before 10 years is complete, that you then get your unlimited tax-free loan forgiveness on the balance once the 10 years are done. For this borrower, it was $337,000 forgiven, actually more than what they borrowed. So they only really paid interest back, and not even all of it, over the course of that 10-year period. So let's do a case study here. Let's say you're speaking with or being recruited by a hospital who maybe offers some loan repayment to you. I know several hospital systems that offer $20,000 of loan repayment annually for 5 years. And so that's $100,000 of payment benefit. It's typically taxable. You're going to get all the money and then owe the taxes at the end of the year if it's a taxable benefit. And they normally make these payments directly to your loan servicer. They require that you show documentation that you made the payment from these monies directly to your loans. So how would this strategy work if you're employed also by a 501c3 that's paying this $100,000 over 5 years? Well, if you were coming out of school with only about $100,000 of student loan debt, pay down your debt with that benefit, possibly refinance if you can get lower interest rates. You're going to want to come out of pocket as little as possible here over these 5 years. That should be, less than $25,000 that you're coming out of pocket. And that's really just the tax liability that you've assumed over those years of getting that benefit. You don't want to overlap these payments. So if a borrower has $300,000 in student loan debt and they're using an income-driven repayment plan, we would want to make sure that you use the $20,000 to make either income-driven repayments, make your monthly $800, $900, $1,500 a month payments that count towards PSLF. You're even permitted to make a lump sum payment and indicate that, for example, a $15,000 payment that was based on a $1,500 a month income driven repayment plan payment, you could make a lump sum payment for the next 10 months. Keep in mind that you have to renew an income driven repayment plan annually, so you can only make lump sum payments up until your next renewal is. But you just want to make sure that you don't, that there's no overlap of these monies as best possible, so that ideally you want to, with a hospital that's paying this generous of a student loan repayment benefit, hopefully you can make all of your income driven repayment plans with that money and not ever come out of pocket at all or very little. So it depends on how much debt you have and what your household income looks like, how you want to line that strategy. You know, there are resources to help you out strategically with this. In years past, we've seen PSLF being denied. Up to 99% of applicants were being denied in 2018, 2017. That was the 10-year anniversary of when PSLF was created back in 2007. But because income-driven repayment plans weren't being promoted by loan servicers or even really during exit counselings, and then most borrowers had these FFEL loans, there weren't a lot of borrowers that were eligible for PSLF, even though they thought they were meeting the requirements. So this has changed dramatically since October of 2021, when the Biden administration announced the PSLF limited waiver. So instead of those strict requirements about having direct loans and using an income-driven repayment plan, anybody since 2007 that had outstanding student loans and they weren't still in school, they could be direct loans, they could be FFEL loans, they could be Perkins loans. If they made any payment on them, they didn't have to be an income-driven repayment plan, or if their loan servicer steered them into forbearance, as I mentioned, the F word, for longer than 12 months or 3 years cumulatively since 2007, while they had outstanding student loan debt, the waiver is counting all that time towards PSLF. So we've seen literally about 500,000 borrowers get complete tax-free loan forgiveness as a result of the waiver. So who needs to consolidate their loans? You need to make sure those FFEL loans, if you still have them, are consolidated over to direct loans. You have until the end of this year to do that. If you have FFEL loans or Perkins loans, you should just consolidate them as soon as possible. That would be the first action item. If you already have all direct loans, the way to get the loan servicer, which is MOHELA now, and studentaid.gov is the federal website for all of this. The way to have your servicer go back and review all of your payment history to confirm you were in a long-term forbearance, you were in a repayment status. Anytime since 2007 on direct loans, you need to do a PSLF form. Now that's available from studentaid.gov, the PSLF help tool. You want to make sure that an authorized official at your employer, if you're doing this now in residency, it's probably someone from your, it's probably for your residency coordinator, program director, maybe your GME office fills out these forms for house staff reactively. And we recommend that this be done once a year. If you want to trigger a payment count to review your history and have past what were not qualified payments count via the waiver, you've got to fill out a PSLF form that certifies you worked full-time for a qualifying employer. And then they'll go back and review the history. And again, that's where we've seen close to 500,000 borrowers getting over $25 billion of federal loan forgiveness, even for folks that have been doing this since the early days of PSLF, 07, 08, 09. When they've made more than 10 years of qualified payments and they were previously told, no, they're not eligible for PSLF, then the waiver came out, they consolidated the FFEL loans, which immediately made them eligible. They made overpayments for, say, 11 or 12 years. They're getting refunds based on overpayments. So we've seen a number of borrowers even get refunds. So this is a very real thing. If you have older federal student loans that still need action taken on them, or you were in some non-qualified repayment status, you're going to want to go complete a PSLF form and get that time counted towards PSLF while this is so generous. As you can see here, as I mentioned, it's close to 500,000 borrowers now. And there are about 1.5 million borrowers actively pursuing PSLF today. I assume that some of you logged into this call are amongst this group as well. And the average borrower's got about $100,000 of federal student loan debt outstanding. There are other repayment programs, National Health Service Corps. These many states have repayment programs for if you work, say, in an underserved area, you'll be eligible for annual loan repayment, and that's usually not taxable, from programs like Stephen M. Thompson in California, National Health Service Corps, where I live now in Arizona, has a program. And these offer you loan repayment for working in a qualified or underserved area for X number of years, according to that contract. When you're getting loan repayment from an organization like this, you're from a program like this, you're not going to be likely taxed on that money. So all of it can go directly towards you, either your student loan debt, if you're not a PSLF candidate, or if you're a PSLF candidate, you're going to want to make your income-driven repayment plan payments with that money. And again, align the strategies as best possible so that there's no overlap of benefit. But you can again use these programs together. You can use both. Repayment that you get in those years of service will reduce your debt, make your income-driven repayment plan payments, and then any balances left outstanding at the 10-year mark would then be forgiven with no tax consequences and no limit. Some employers are now offering contribution platforms. This is where they'll make payments on your behalf to your student loan servicer up to different amounts for different programs. With this Section 128 allowance that has come out now for employers that do this across all demographics and all income levels, they're allowed to, the recipients are allowed to not be taxed on up to $5,250 of student loan payments they get from their employer via the Section 127 allowance. Now, if an employer is making contributions to highly compensated employees like you guys, that money may be taxable. So you want to align that strategy with PSLF if you're also working for a PSLF employer. And we talked about what those taxable bonuses or loan repayment look like as well. In terms of evolving legislation, we do expect payments to resume here at no later than September 1st, unless something different happens or some new emergency declaration is announced. The understanding is that COVID, now that May 11th is approaching and that emergency declaration is formally come to a close, that the COVID emergency couldn't be used to extend student loan repayment again. We'll see what they come up with if there's a desire by this administration to continue to extend the payment halt. If that happens again, we assume that all these benefits we're talking about would just be extended further. If you are in an income-driven repayment plan now, they're not going to ask you to recertify your income until next year, 2024, even if payments start in September. There'll be probably a 6-month lag before they start asking for recertifications. So really, my advice to you here is, unless your income's going down for some reason, don't proactively recertify your income for an income-driven repayment plan. If your income's higher than it was in 2019, when it's probably the last time they used a tax return to set your payments, and then you had no payment, we would rather see them use that tax return to keep your payments coming out of the CARES Act than some updated one that showed a higher income, particularly if you've transitioned to practice. So hopefully that makes sense. And then you got to certify this PSLF annually. They recently updated this tool to now it's digital. You can get your signature done right here, right on the PSLF help tool website. And you can digitally sign it now versus that cumbersome process of printing, signing, scanning, sending to HR, who then has to print, sign, scan, and send it back to you to then submit. Now you can do this digitally, and your employer can as well. That's embedded into the PSLF help tool. We talked about refinancing and the suitability of that. If you're transitioning to practice to a for-profit organization, PSLF isn't going to be suitable for you when you're earning enough money to aggressively pay down your debt. That's going to be when refinancing it may be appropriate to you. if you have 6.5% interest rates on your student loans, and you can get as little as 4.5 or 5% in today's marketplace, that is worth doing if you're comfortable with a repayment plan. Lowering the interest rate, if you're not going to get federal benefits coming out of the CARES Act when you're going to have to go into repayment, it can be a better outcome for you. And with these refinancing companies today, they're not going to charge you origination fees or prepayment penalties or anything like that. So if rates come down a year or 2 or 3 or more from now, you can always refinance an existing refinanced loan. So, and these companies will be hungry for refinancing when rates come back down again. And so, you can lever them against each other to get the best rates possible. But understand that refinancing is only ever suitable if you're not eligible for federal benefit like PSLF, and you're ready to aggressively pay down your debt based on your income profile, and your rates on your federal loans are just too high, which I believe for graduate students they are and have been for a long time. If you want some help, we've partnered with Practice Match for individual borrowers and employers to make sure you have different levels of support available to you. For Benelevate, if you want a tech-enabled PSLF opportunity assessment, these normally cost $50. You get a 15% discount. You can register for these right at benelevate.com. You would use the coupon code PM15 to lay out your strategy and see what action items you have, and then what your savings looks like, and how to keep that going annually. We're going to estimate total savings, total payments, make a repayment plan recommendation, present refinancing options, if that's appropriate, give you the analysis for tax planning that you would need. For example, what your loans would cost married filing separately versus jointly if you're married. And then we facilitate digital signatures and submit the PSLF form as well. Doctors Without Quarters is available to do one-on-one deep dive consultations with you and talk about how this impacts other areas of your financial life. So we will do a consolidation with you. We will populate your PSLF forms. We'll do your income-driven repayment plan selection. We'll go through all of those applications with you in real time in an hour-long consultation. And as a Practice Match member, as a Practice Match candidate, you get a 15% discount on those services as well. You can go to doctorswithoutquarters.com. Actually, all of these benefits are also listed on the Practice Match page. And Peyton, if you want to send that page out to those who have attended here, the list of benefits and how to register for them is listed on the Practice Match student loan benefits website as well. But the code PM15 can be used across the board for one-on-one support and for any of the tech-enabled tools. That is all I have for you guys. I've wrapped up in a decent amount of time here, but happy to answer any questions you guys have.
No, thank you, Jason.
Yep.
I will send out to everyone attending tonight an email. It'll probably be later tomorrow because I'm traveling tomorrow for work, but I will send that information out to you guys. And I see that Lauren had a question, but said that you had answered the question on the slide.
I've been doing this for a long time. Sometimes I know that's going to happen, which is why I say hang till the end, but yeah. Happy to answer more questions.
Yeah. So, Lauren, if you have anything in addition to that, that Jason can answer for you, he will be happy to. But if anyone else has any questions, we'll hang out a couple minutes just to make sure that those get answered. Okay. Where can we review this presentation for future sake? Later this week, it will be uploaded to our website. So which again, that will be in the email that I send you this week as well. If you go to practicematch.com, and then you can click on, I think it's for career resources. It'll be under webinars, and then there'll be a tab right next to the webinars that say past webinars. So that recording will be on there, as well as other webinars that we've done with Jason. You are welcome. And if anybody else has any questions, hang on a second, just to make sure we get those answered. But if not, I want to thank you guys all for attending tonight, and thank you, Jason, for your time. Like I said, I will be emailing this information out to you all. So if you have any questions, please reach out to Jason or myself for anything. So,
Thanks. Have a good evening.
all right. Thank you, guys.